Today we're going to talk about the basics of options terminology and just the terms that are most used when it comes to trading options. My goal for this video is to show you guys how and why option trading can benefit you. Obviously, so you guys can understand option trading, and then what our signals in the Discord actually mean. So if you're reading it and you're part of the team, you know what we're doing, and you guys can execute and profit on plays too. So what is options trading? It's different from buying normal shares of a stock. So when you just buy shares of a stock, you're buying it at the share price that it's at, and then you're just hoping that it goes up in price. So say you buy, to make it easy, stock and the share price is at $100 in the dot. If you buy one share and it goes up $1, you'll only profit $1. With options trading, you're basically anticipating that a stock is going to increase or decrease to a certain price. And when trading options, you're buying contracts instead of just actual shares, like I said. And we'll discuss that later in the video. So basic terminology, a call option. This is what you buy when you are anticipating that the share price of a stock is going to increase to a certain price level. So basically you're just betting and saying that it's going to go up. A put option is the opposite. It's what you buy when you are anticipating that the share price of a stock is going to decrease to a certain price level. These price levels that you're anticipating the stock reaching is called the strike price. The strike price is the price that you're anticipating your option to go to. And the expiration date. So when you buy or place a call or put option, whatever it may be, either way, you always have to select an expiration date with the contract. So by selecting an expiration date, you are anticipating that your option is going to reach your strike price before that date, which we'll explain right here, I believe. So I did these examples in Robinhood just because if you're watching this video and you're just getting into trading options, you're most likely using Robinhood, which is what I did when I started trading as well. It's great for beginner trading. So yeah, we'll just talk about this and how to actually place a call option in Robinhood. And it's the same thing for a put option. You just do the opposite of what I'm going to explain. So right here on the left, where I have the first screenshot, we're going to use Snapchat as an example. So if you're on your phone, which is where these screenshots were taken, if you type in Snap, that's the ticker, it pulls up to this screen, and then you'll click Trade right here. Once you click Trade, you'll see Trade Options or Buy. Now, if you don't see Trade Options, it's because you don't have options trading enabled, and it's super easy. I don't know exactly, like, off the top of my head what settings you have to go into, but just Google it. You can do it in like 5 minutes, or apply in like 5 minutes, and it might take a day or so. But it's very easy. So if you do have this, click trade options, because that's what we're going to do for the sake of this video. The next screen you'll see is this middle screenshot, sorry. So if you're doing a call option, like I said, you're anticipating that the price is going to go up. The share price of Snapchat is going to go up, right? So this is the screen that you're going to see. So you click the up arrow. So Robinhood makes it very easy for you to know what you're doing. And then after you click this, so to get to this next screen, you have to click an expiration date, like I previously explained. So once you click the first expiration date, which is the closest one, it's August 7th. It'll pull you up to 3, the next screenshot I have here. And this is where you can choose your actual contracts and the orders that you want to place based on your analysis and what you're trying to do. So right here, so say we want to do a $23.50 call, right? So as we can see right here, the share price of Snapchat is currently $22.73. So I'm not saying go do this, but for the sake of the video, if we were going to place a call to $23.50 as a strike price, that's the strike price right here, we're anticipating that this $22.73 is going to go up to $23.50, or at least approach it. So that's a strike price right there. That's the price that you're saying it's going to reach, or it can reach. Right here, the 28 cents that you see, that's the price of the contract you're paying for. So when you buy a contract, you're buying like 100 shares of it or something in like a different way. It's like kind of technical, so I'm not just going to explain it low-key because I don't know the exact technical terms for it. But whenever you see these right here, just multiply it by 100, and that's going to be the price of your contract, how much you're going to have to risk, and how much you're going to buy the contract for. So the top one, 0.19, that would cost you $19. This one would be $28, 43. And Snapchat's a relatively cheap stock, so cheaper stocks tend to have cheaper contracts. Snapchat's options contracts are way cheaper than, say, Apple because they're trading at a very high level. So say now that we're going to look at this $23.50 call, right? We click on this. It's going to bring us to this. So now you're actually at the point where you're going to buy the contract. So you selected what you wanted to do, the $23.50 call expiring on August 7th. You can type in how many contracts you want. Definitely, if this is your first time trading trading options, just buy one contract with like a cheap stock. Snapchat's a good example of this because you don't want to get in over your head and lose all your money. So you literally type in one. As you get used to it, you could buy 10 if you think you're going to profit more, or 5, or however much you want. The biggest question kind of that I get about options trading is the bid and the ask, which can be very confusing. The way I like to think of it is just as an auction, right? So in the market, you have buyers and sellers. That's how the market moves. So with an auction, people are selling something. And when you as a trader, you're going to buy this snap call option, you're going to have to buy it from someone. So you're essentially buying this contract from someone, just like an auction. You show up to buy something from someone. So the bid price is like, say, what the 0.26, so that would be $26. The bid price would be what the buyers are like, they want to sell and get the contract for $26. On the other hand, the ask is what the sellers are selling the contract for. So the sellers obviously don't want to just give the buyers, because they would lose $3 here. They want to meet somewhere in the middle. So say you're buying a hat from an auction, and the hat's originally for sale for $29, right? And someone shows up and says, I'll give you $26 for it, which is the bid. You're probably not just going to say, okay, take it. You're going to negotiate or whatever you want to do, say maybe $1 less, or it's a strict price. So that's when the fills come into play here. So you're more likely to get filled if the limit price, so the limit price here is 0.28, is closer to the ask price. So yes, we're coming down and paying $1 less than what they're asking for, but the market is more willing to sell that to me. So my order is more likely to get filled. Whereas if I just did a strict limit price at 0.26, I could get filled, but it would be less likely. So yeah, that's buying the contract. So now once you have the contract, you're going to wonder, how do I profit off of options just in general? So it's value-based. So this isn't Snap. This is just another example. This is actually from the Discord from the beginning of July, as you can see. So BA is Boeing. That's a ticker symbol for Boeing. So this bottom half right here, this is what I bought the contract for, and the top is what I sold it for. So it's value-based, meaning that I want the value of my contract to be more expensive or higher in value than it was when I bought it and I sell out. Thus, I would have more money in profit. So as share price of stock approaches strike price, or it goes in the direction I anticipated it to, my contract's value appreciates, which is what it did here, right? I placed a call on Boeing expiring on July 2nd with a $190 strike price. So clearly it went in my favor. The stock went up either to $190 above towards. So it went in my favor. I profited $176, which is good, right? So I made money here. So my value of my contract appreciated. Where on the other hand, if the stock price moves further away from the strike price that I said it was going to go to, my contract value depreciates, which is bad, obviously. So say I place this Boeing 190 call and it started to go down, and I was like, oh shit, like I'm losing money. The further it goes down, the further it goes in the opposite direction, the more money you lose. So you want it to go in your direction. You want it to go, for example, on this, up because we did a call, which is what happened. Then lastly, the value of your contract can decrease the closer you get to your expiration date. So that's important. You want your options and your anticipating moves to happen quickly because you can profit more the quicker it happens, which we'll talk about soon. So another big question I get is, when should I sell my contract? So best case scenario, if you get an option and the price moves in your favor, you want it to happen quickly because of the expiration date. Like I said, you want it to happen closer to when you place it rather than closer to the expiration date, because there's a bunch of like algorithms and shit that go into it, which is more advanced, but this is beginner. So just know that you want it to happen quickly. So best case scenario, the trade goes your way, so you're profitable. At this point, you should consider taking your profit by selling your contract. So if you are profitable, the value of your contract will be worth more than it was when you initially bought it, thus making money, like we just explained. Little tip, it's easy to get greedy and be like, oh, I already made, say, $100. I can make another 100. But you have to be comfortable and be happy taking profits and moving on to the next trade. Worst case scenario, the price is going in the opposite direction of what you anticipated. So you should consider cutting your losses if you feel like the stock is not going to recover in your favor. So this means the value of your contract is worth less than what you initially bought it at. So you're losing money. And a big tip, no matter if you're a beginner, intermediate, or advanced trader, nobody shoots 100%, meaning that you have to be okay with cutting your losses and just learning from it, moving on to the next trade, and just admitting that you were wrong, because it's impossible to be 100% when you're trading. It's just all about putting yourself in the highest probability setups and the highest probability trades. So yeah, be okay with losing and know when to cut losses. So trading options in general, pros and cons. You have an opportunity to profit quicker than just buying normal stock. You have an opportunity to profit regardless of if prices are rising or falling. This means that I can anticipate that the price is going to go up, which is good if I do a call option. But I anticipate that the stock price is going to go down, I can do a put option and I can still make money, which you can't do if you just buy normal stocks and normal shares of a stock. Cons, it can be more dangerous and you have to understand the expiration date. It's really important to understand when to sell if you're losing money. If you're going down, don't just be like, okay, I'm going to hold it until I lose less money. Sometimes you have to be okay with just saying, okay, I'm going to get out of it and forget about it, put it behind me. There's no point in dwelling on it. Learn from it and move on. And understand the expiration date. It's not necessarily a con, I guess, but like it can be if you don't understand it. So just know that you want your move to happen quicker rather than later towards your expiration date. So now moving on to Mack Trading's Discord signals. Just so if anyone in Mack Trading Discord is watching this that doesn't know what some of the signals that we post mean, we want to just clear this up. So Bodacious here, this is the exact signal that he posted in the Discord, right? So he said, just placed an EA call, 724 expiration, $140 strike. So he signaled that he's placing a call option, right? Call option on ticker symbol EA. That's the company. He chose 724 as his contract's expiration date, and that he chose $140 as a strike price, which is, like we said, the price he believes that EA is going to reach. So he wants to see EA's stock price to go up because it's a call option. Another example right here. This is on a Boeing play, which is ticker symbol BA. So this is a little more advanced. Otto said BA break above $169.75 for calls. Scalps, which is scalps are just quick day trades. He said break below 168.69 for puts. Wait for candlestick confirmation, volume 2. So he signaled, he is me, by the way. So I signaled a call option on Boeing, right? BA. But only if, that doesn't mean I'm in yet, only if the price breaks above $169.75, because we're waiting for that candlestick confirmation right there. So we can be more sure that the price is going to go up and put ourselves in a higher probability setup and a higher probability trade, which is what we want at the end of the day. I'm also watching to see if Boeing drops below $168.69 here. For puts, strike price, in this case I had at $167.50. And again, I'm waiting for candlestick confirmation, so we have high probability setups. So I'm just waiting for the price to go above this level for calls. If it doesn't, I'm not going to place it. And if I was going to do a put and the Boeing stock started to decrease, I'm waiting for it to break below $168.69. And if it doesn't, I probably won't place it. So those are just basics on trading options. I hope you guys learned something. If you have questions, comment below. We're happy to make another video or just interact with you guys in the comment section. Go follow our Instagram at Mack Trading. We have free Discord, daily signals, talking stocks all day and shit, long-term investments, whatever you name it. We're in there. It's free. It's in the link in our bio on our Instagram at Mack Trading. Thank you guys again. Peace out.